Hello everyone, it's Alex Suslov, Head of Capital Markets at ADM Mortgage. We're here today for our AD Weekly Digest to talk about our special market news, mortgage news and non-QM features. Today we see Freddie Mac rates were down last week to 4.99%, and it's the first time in the past months, I believe, when we see 30-year conventional rates being under 5%. Non-QM rates at AD Mortgage were down 80%, and we're at 7.5% average non-QM rate today for our bank statement and DSCR products. I believe those Pontiac GTO 69 lovers will have a deja vu today, since we see the lowest unemployment rate since 1969 today. That is surprisingly to me, with oil being about $100 per barrel. We saw some downward in oil last week, but since oil is pretty high and we see a lot of layoffs out there in the market, and that's a little bit strange to me to see the lowest unemployment numbers. I think there's some lag in the numbers, and we'll see a higher unemployment going forward. Next week we have CPI numbers, which I believe also would be an identifying point for Federal Reserve in their move in September. And we have Billy Abrams, our market technician, here with us today to comment on more details on the strong economic numbers that we see on the market. Billy, can you please share your opinion on the market with us?
Hello, Alex. Hello, everybody. Let me start by saying that anybody that had a GTO in 1969 and got the feeling of deja vu because of the jobs report, they were also filling that car up for 35 cents a gallon. So those deja vu thoughts will dissipate pretty quickly. On June 14th, the 5 and 10 year made their high yields of the last couple of years right around 350. That happened to be where everybody in June thought Fed funds would be by year end. They began to rally, and this past Tuesday, the rallies seemed to have ended. And where did they end? The 10-year was at 252, while Fed funds were at 250. So 100 basis point rally from where they thought Fed funds were going to where Fed funds were. A day later, the 5-year had already backed up, I think, 39 basis points. So it got rejected pretty quickly. We've since found out the BLS report came out, the jobs report, non-farm payrolls, expected to be up 250,000, we're up well over 550,000. So a massively strong jobs report. The Federal Open Market Committee, the Fed, is mandated to do two primary things: keep inflation down, keep the jobs market strong. Right now they don't have to worry about the latter, they only have to worry about the former. So I think we can expect the Fed to remain aggressive. The next meeting is around the 20th of September. Fed funds by then will probably be pushed to 3.25. Could be 3%, could be 3.5. Let's shoot for 3.25. That tells me the 5s and 10s will be trading above 3.25 by the end of September. Technically, which is what I do best, I think these markets, I have thought for months, they'll be trading ranges. It should last 3 months, at least 3 to 4 months. I think we've seen the first leg of the correction. I think rates are going to move back up into the low to mid 3s for the second leg of it. I think there's probably one more rally before year end, and then I see rates going back up. So we'll see how that plays out. Next week we have CPI, and that part will be interesting. If any of you would like to keep up with my market comments on a daily basis, shoot me an email at billy.abrams@admortgage.com. I'll be glad to include you on my distribution list. Alex, back to you.
Billy, thank you so much. That was a great overview. Can't agree more on all the points. That's really very interesting comments for our audience, I believe. Thank you everyone. It was Alex Suslov with you for our AD Weekly Digest. Please sign up to our YouTube channel to watch our weekly webinars and weekly digest. Stay tuned.